So great to see you all, and welcome to our Companies and Trusts and Global Wealth Club, the part 2 of our series, which we're looking at today. So who was here last time? Just type a Y if you were here for the last one. Okay, quite a few of you are here, which is good. So let's get started now and have a bit of a look. So the first one you may remember was all about tax minimization and asset protection generic principles. So what we're going to be doing today is we're going to be doing the next part of the series. We're going to start doing a little bit more actual educational teaching for you. So we're going to go through and actually break down what you're teaching and what you're learning and things like that. So let's get started anyway. So of course, as usual, we have our disclaimer to get things started. Although we're educating you, and although obviously we make every attempt to make this accurate and informed, like anything, you've got to see a professional advisor financially or accountant legally if you want to really make sure for your personal situation. So what we're going to be doing now is just as normal housekeeping. We're aiming for a good solid 60 minutes of solid teaching, where it'll be followed by questions and then be followed by how you can take some action in the next step. So let's get onto this and let's get underway. And we have a good turnout today, it looks like, which is great. So now, the hard truth that nobody wants to hear is that we pay too much tax. This is a bit of an overview of what we talked about last week. The biggest problem we face in the West is the amount of tax we pay. Just raise your hand or type a Y if you like, if you think you pay a lot more than you really should be and wanting to be paid. Just type a Y or raise your hand. My guess is most of your hands are going up like crazy. So that's kind of so most of you. So what we're going to be looking at now is how can we legally go ahead and do things and get a much better outcome for yourself, so to speak. Like, how would you do that? So we pay way too much tax in the Western world. And one of the problems we've got is that government's basically trying to redistribute money. And it's a whole concept, but governments no longer see money as belonging to you. And even for those of you who are on the Charlie Kirk podcast we ran last night, where we had myself, we had James, who's my young son who studied psychology, he's a bit of a free thinker and very unprogrammed. And we also had Shaquille Adam make a guest appearance, who's just closely associated with Turning Point and Joe Jamal. He works with Joe Jamal, he works with Charlie Kirk, and he's had discussions with Charlie Kirk and gave some very useful insight into the whole thing and just how much we're living in a world where freedoms and rights are being taken and governments are starting to see your money and your things as at their discretion. Whereas basically, as he was saying, is that it's not. It's a right to life, liberty, property, and the wealth that God has given us. That's the whole idea. And the idea of taxes or contribution is one thing to contribute to the society we live in. On the other hand, it's when we start to move beyond that. You start, is it really any more contribution, or is it basically gaslighting and theft? So it's time to wake up to the reality that the tax system is rigged against the ordinary person. And that's the reality that we face. And the elite know that very well, as we showed you last week when we showed you the actual statistics, that according to the 2016 Sydney Morning Herald study with Peter Martin, only 2 of the top 56 Australians paid any tax at all, thereby proving the point. So, again, Mr. Packer's legendary quote, which we gave last week, but pretty much gets you back to the purity of all this, and becoming the master of your own reality. So really, that's what I'm aiming to teach you, along with Trent, who's here as well, about helping you become the master of your own reality. So you become the creator of your life, where you contribute because you want to, but you don't give any more than you absolutely have to, in the words of Kerry Packer. So this is one of the things we showed last week, was the tax matrix and how this actually works. We've got this 4% wealthy, 1% elite. And the reality is most people live a life of slavery. And really, one little interesting tidbit for all of you is that the word employer and employee, if you study language, came about because originally the correct word was master slave. And I'm not kidding. If you go and look at common law legal case books, but of course the elite realized that the peasants wouldn't particularly like being called that. So they changed it to employer-employee. It sounds a bit more cute. But the actual original term in legal case books in the law library back 50 to 100 years ago was master-servant relationship or master-slave. And again, it's fine to be a slave as long as you're doing it consciously and recognizing that you're happy to do it. And if you're not happy to do it, start looking on a path to liberate yourself to freedom. And as this matrix shows, the top group and the lower group don't pay taxes. The middle group paid a whole lot, keep it going. And I had a very interesting discussion with my son the other day about socialism and how the younger generation are calling out for it and saying, is it possible socialism could actually solve the problem? And I said, socialism works great while you got people to fund it. I said, the problem is eventually people stop wanting to fund it. And the example I gave him was, I said, let's just say, like I've got 4 sons. I said, you and Ed, this is James, my twins, James and Ed. I said, imagine that you guys start a business at age 15 on YouTube like you did, and you start making $2,000 a week, okay? And he goes, yep. So I said, if Mum and I asked you, would you give us $300, like maybe 10, 15%, because the fact is you're using our electricity, our house, all our resources, do you think that would be fair? And then he thought about it and said, yeah, that would be fair. I said, 10% you probably would pay ideally, but you probably will live with 15%. I said, let's just say what I said to you, I want you to pay 40%, $800. And you'd be like, why? And I'd say, well, it's not really fair that your brothers, William and Joe, don't have any money. And we think, and so it's not really fair on them because they're basically struggling. They can't meet a lot of their stuff that they want to do in their life, whereas you guys are having a great life. So we're going to take $500 from your 2,000 and give $250 each to them. I said, what would you say? And he's like, that's outrageous. And I said, yes. I said, what would you do? So eventually we worked it out that he would probably, I said, let's just say that I let you go and spend $500 a week in paying for marketing expenses for your business, and you could take that off as a deduction before you paid William, Joe, and the family. He said, yeah, I probably would find a friend who I could fudge an invoice with. And I said, yeah, and you'd fudge an invoice with a friend and you would, get yours down, but you would be starting to build your wealth. Yeah, and he said, I'd be starting to make money and trying to get myself away from your house and live away from you. And then he laughed. He goes, I said, yes, you've just had a 5-minute lesson in the tax system. And I said, and you're unprogrammed, so you get it. I said, most people are very programmed, hence they're stuck in the matrix. And they're going to probably never get out, most people. And some will get out. Some will want to get out but not get out. Some will get out, but very difficult, and some will get out really well. Just type a Y or raise your hand if you thought that was a pretty cool metaphor. It just sort of came off the cuff when we were chatting. It literally cured my sons of any thought of socialism overnight. So yeah, it's when they realized it, because it's really good to talk to you for unprogrammed. So if you didn't listen to the Charlie Kirk podcast, we're sending an email out, and it's a 10-minute, we got a 10-minute highlights reel. And my friend Shaquille, who was on there, just to get, like I said, he knows Charlie Kirk. He's very connected. To give you an idea who this guy Shaquille was, who was on the podcast last night, I was with him in the Maldives a few years ago, analyzing some sports betting stuff with him. And he has a call, and next minute he's talking to someone and introduces me, and I'm speaking to the Crown Prince of Kenya, the third most important person in the whole of Kenya, who's Shaquille's friend. They're just having a chat. And then Shaquille was all over the media because his greyhound, Handsome Prince, a few years ago, won the most amount of money won by a greyhound. So interesting chat. Good to kind of think outside the box, because our system is in a really shitty place right now. And this is why this is part of this series today, to help you, if you haven't done this yet, to at least start the process of thinking like the wealthy and starting to structure yourself if you haven't done that previously. So that's what we're covering today. So basically, the rich know that the more money you make, the less tax you pay. I kind of covered that last week, so I won't go over that again. They know it works in reverse, and they know that you don't pay any more than you legally have to. One of the things I want to mention to go into companies and trusts and why they're so important, it's important to understand a little bit more about how income taxes actually work. And you realize that they're basically, think of them, they're basically part of the 10-point Communist Manifesto, okay? So when Marx created the ultimate model of state centralized wealth to basically address inequality, one of his things was you're not really going to be able to do it if there's too much private wealth. So what you've got to do is you've got to equalize things out a little bit. You've got to pull the wealth away from the rich, move it into a centralized system, and then distribute it fairly and equally so everyone benefits from it. And of course, in principle, it's like, sounds pretty great. In practice, of course, not so great if you've been one of the ones building the wealth and doing the hard work, and then seeing your wealth go to other people who haven't been doing the same kind of thing. And so income taxes was a very important part of the Marxist plan to actually take money away from the wealthy and move the money and from the middle class, centralize the wealth and let a centralized government board choose that, the decision. And as crazy as it sounds, it's been going like this for years in Australia because most Australians have actually wanted this. Again, like most Australians wanted COVID, they wanted to be told what to do with the vaccine. And so it's very important that when you learn this stuff, you've got to start to think on a whole new level of thinking in your mind. You've got to start you've got to start thinking about and realize you've got to become almost a head of bronze. I told my sons, you've got to be like Donald Trump, a head of bronze, where no matter what comes your way, you don't give a shit. You really don't. Because you're always going to be getting people not happy with what you're doing. You're going to have the government, the system. If you really start to take care of your own affairs, your finances, and start to basically shake the chains of socialism off your back. Just raise your hand if you would love to fund socialism, and that's kind of your dream. Raise your hand. So far, no one. Okay, raise your hand if you really would prefer not to unless you do it by choice, or give me a why. Few hands going up. Who wants to control where your funds go? Hopefully a lot of you. And there's many other things that I won't extract from today's podcast. I did say to my son, half the reason, which I did say to him, half the reason we've got this problem is that we don't really take responsibility enough as capitalism. That's why once you go through this system, why we're also big on setting up foundations. But for now, we'll stay focused on this. So wages earners and contractors get hit the hardest. This is something that Robert Kiyosaki talks about in Rich Dad Poor Dad. He says, what's ironic is in 1915, when they bought out the, when they announced they're going to be bringing taxes, the government go to the Americans and Aussies like, hey, we got some good news for you. We're going to bring some taxes in, but guess what? It's not for you. It's for big corporations. So don't you worry about it. Pat it on the back. That's actually what happened. Like, don't worry, we're only going to tax the rich. And of course, 110 years later, the rich do not get taxed and the middle class pay all the tax. So wage earners, when people come to me now, I have not helped wage earners with tax planning since 2008. I pretty much gave up. I realized there was jack shit I could do for him. Contractors, I can to a limited degree, still quite less. We do contractors. I generally work more with business owners and investors, but we do work with people who are contractors, or this is why it's great having Trent here. Trent is like a game changer for me because Trent likes helping wage earners step out to the next stage of the matrix and freedom and to becoming contractors, or contractors stepping up and becoming business owners and restructuring your affairs and finding a way. Because basically, as Robert Kiyosaki says, when you're a wage earner and contractor, you generally earn, then you pay taxes, then you spend. Whereas a small business owner or investor earns, spends, then pays taxes. Whole different matrix, whole different ballpark. So they're audited by the tax office the most because it's very easy. There's not much they can do. We're not going to pay lawyers. We're just going to take it as it's done to them. Meanwhile, the ultra wealthy, they either rarely face serious audits, or if they do face it, which they are more these days, I'll admit, they have got money to engage lawyers to fight it, to argue it. But by and large, it mainly targets the defenseless because it's easy money. The higher people, they do audit, but more for show, knowing that a lot of the time you're going to have to take one for the keeper and basically come up with some kind of settlement or deal. So this is how it basically works. There's nowhere to hide. You're a slave, basically, and as a slave, your master knows what's going on, and then your master must report to the tax office to let them know of your slave earnings. Now, the biggest secret that the wealthy use, or even contractors use, is they start to separate their affairs basically from themselves. And what I might even do is I might just jump on and grab you a quick diagram that shows you exactly what I mean. So I'm just going to get one. It's not on the slides, but this should help you get a bit of a better understanding. It's a bit slower because the Zoom bar has to be moved around. So, okay. Sorry, Zoom has gone weird on me. Okay, there we are. Okay, so this is basically how it works. So what we're doing is we're separating you from your assets. That's the basic idea. So this is a very simple structure that just about anyone who is contracting or business or investing should have. I always say if you're in business at a bare minimum, you're going to want a couple of structures at an absolute bare minimum. You're going to want to have your trust or company structure, and you're going to want to have this separate from your investments. And that's an asset protection reason. You may remember last week about tax asset protection. There's two reasons you got this happening, okay? So let's just say these are my trusts. This is a separate entity from me. So what that means is in law, in the fiction of law, what the courts and government say is, hey, this trust, the Wazza Business Trust, is a different person to Wazza, the person. It's like an AI thing, like a robot of me. And then the Wazza Investment Trust is separate again. And why that's important is if someone sues Wazza, then Wazza's investments are sitting over here. And it's like basically someone, say, trying to take Trent's money by suing me. It's like, well, you know, Trent would be like, oh, I mean, I love Wazza, but I'm tied up with him in any way. So if he's liable, you deal with him, not with me. So that's how it basically works. So there's Wazza, then there's the trust over here. So if the business gets sued, as well as being separate from investments, the business is separate from Wazza. So now it's harder to sue Wazza personally. So this is why Uber alone have 9 structures just in Netherlands, not even including all their other ones, to give you an idea. That's how seriously these big groups take their asset protection and their planning. And I can always tell someone who doesn't get the game and who's going to be limited in wealth creation because generally they don't have structures or don't understand it. Anyone who takes wealth building seriously is always setting up their structures. So that's basically how that works, so to speak. So that's the biggest secret, is using separate entities. So it's where the game changes completely. So you're into a whole new tax system. And so it's a really good thing to know. Now, keep in mind today, it's going to be building in layers. Like we're going to be teaching specifically next week on crypto structuring for those of you who are in cryptos. If you're in cryptos, just type a C in the chat if you are a crypto person and would like to know more about structuring cryptos. So just type a C. Excellent. Plenty of you. We're going to enjoy next class. And then after that's going to be the juicy one. And the juicy one that you really want to learn, really, is this one. The basically offshore. So in other words, how you can set up outside of Australia. So let's just say you've got investment and business trust over here that you've got overseas. And that just means that if you get in trouble in Australia, you're overseas. So it sounds like an ultimate plan B for AI, for government targeting people's wealth, social credits and everything. But like I said, you do things in stages. This is a sneak preview in 2 weeks' time. Today, what we're doing is we're starting, for those of you who are just simply wage earners or simple contractors and who are quite new to asset protection and wealth planning, and showing you how you can add a new layer to start preparing yourself to become sovereign. Just type today if you're still quite new to all of this. If you're still quite new to asset protection, tax minimization, just type a me in the chat. 50-50. A few of you. just type what we do. Okay, E for experience. Just type E if you know a little bit more, like you're fairly used to this and you just want to improve your game. E. Okay, so if you've got an E, good. So there's a balance of people today. So it's good though to go back to basics. I always like teaching this stuff, even though I know a lot, because it gets me back to basics. So it's good. So instead of earning income, you can structure your affairs through companies, trusts, and other entity. Suddenly, that 48.5% personal tax rate, where you're making a 50-50 partnership donation to the government as protection money, drops to 27.5%, or even as low as zero if you know what you're doing correctly. So stuff like that. So it's not tax evasion, it's tax minimization. Big difference. And like I'm saying, the wealthy, the more money that you make, the less you pay. An example I give here is this. Let's just say that you're making 200,000 a year, or let's say 150 grand a year. And I'm not saying I can do this. I'm just making up a pure metaphorical example. I said to you, hey, if you pay me 100 grand, I will get your tax down from 50 grand a year to 25 a year or 20 a year. Most of you probably wouldn't pay me because you'd be like, fuck that. That's like 100 grand. That's going to take a while. What if you were making 2 million a year? You're about to pay 500,000 in tax. And I said, hypothetically, if you pay me 100 grand, I will cut your tax from 500K to 200K. Who thinks it's a pretty good investment? Type a Y if you think that's a pretty good deal now. You're effectively getting a triple in your money with no risk, effectively, assuming it's all legal. And that's why the wealthy can do it, because when their advisors go, yeah, it's going to cost you $1 million, which is often the case with the super rich, they're going, yeah, whatever, no problem. They don't give a shit because they'd rather pay it to the advisors than give it away to the government. You know, they'd rather keep the economy going. That's how they think. So these are just some other examples as well as structures I've given here. There's all kinds of things you can do. Holding assets, spending money, creating debt and living off debt. There's all kinds of stuff that they actually do to optimize their tax minimization. It's a very different world. And companies, as for a loan, you'll pay less, like a flat rate. In America, for example, you'll have a 15-20% rate. In Hong Kong, you'll pay 15% rate, then you won't even pay it on foreign income. So companies already, you move into a lower tax world if you know what you're doing there, which improves your ability to accumulate and keep more money in your pocket. This is why companies are really good. And so today we're talking about companies. Companies give you a corporate protection for asset protection, and they separate you from your assets. So companies can either be standalone in their own right, or they can be trustee for a trust. So a lot of the time we set people up as trustees for a trust, and that's for a few reasons I'll share shortly. But sometimes you may just set up a company in its own right without a trust involved at all. So when would you do that? There's a few examples I'll give you, which I'll cover shortly. But trust by, for example, by contrast, is very different again. Like you might have a very high rate, you do some income splitting, and you can instantly reduce the taxes quite significantly. And it's gave the example of income splitting here. And rather than paying $89,000 at 44.6%, you now have a 25% effective rate of tax. So even this alone, just for a person starting out, you can make a real difference and things like that. And here's the annual life savings over a period of time. So you can literally save and create $1 million out of nothing just by sitting down with someone like Wazza or Trent and working out ways to just improve the way you structure yourself and legally minimize your taxes. Type a Y if you think this is a pretty decent idea. If you start to think this is really good, just type a Y. Who thinks it's really sexy? Yeah. If you think I'm sexy, type Wazza in the chat. Hey, come on, I've got to try. Most of you. Scott, great. Jody, was it? Yeah, beautiful. Cody, no way. Cody, you're fired as a client. Apologies, it was nice to work with you. Andrea, beautiful. Love all of you. All the ones you said I'm sexy, special deals for you. Okay, so They know that even down the track, if they want to, they can move their affairs offshore. So the ultra wealthy don't limit themselves to domestic tax planning, they go there. So that's another part. But again, we're not going to cover that today, but that's where you can go eventually in terms of the starting point. They can set up foundations as well. So these are all giving you a sneak preview to where this can go. So the main thing is you start with companies and trusts, and once you've got that, then you start to get into a readiness to go to your phase 2 and your phase 3 and your phase 4. And you'll be surprised how fast you can move from being a slave to being a free man or woman. And a little bit of another incentive, the Magna Carta, which many of you heard about, wasn't actually for slaves. It was only for free men or free women. Just type a wow if you didn't know that. It was only for free men and women. It wasn't for slaves, the Magna Carta. Just type a wow if you actually didn't know that. That's why I always watch in amazement when people talk about the Magna Carta and its freedoms. It does, but it was specifically for the barons. And it was specifically done for the barons and the lords, basically. So sole traders and partnerships pay maximum tax with least protection. So in other words, if you came to Trent and I and said, hey guys, we absolutely fucking love the government, we really do. Like, we just think Albo's just the bee's knees. We think Dutton's amazing. We love Lord Voldemort, and we think that new chick Susan Lay is just the best. We want to pay maximum tax. I'd say, great. Okay, let's set you up. And we also want to know that we could be sued and lose everything, no problem. We just like to play on the edge. I'd say, great. So what you should do is set yourself up as a sole trader, because if you do that, you'll pay maximum tax and you've got no asset protection. So if anyone goes after you, you've either got to go bankrupt or lose everything and wreck your credit rating. And then let's say that you said to me, hey, look, Woz, I really don't like that. I want to take more risk. I'd say, great, we'll become a partner. Because let's just say Trent and I went into partnership in our own names. That would mean that, let's say that, we'll make Trent a good guy, because I'm sure he's a better guy than me. Let's just say he and I are partners and he trusts me to do the taxes, and I sneak off to the Bahamas, run away and disappear and leave him with all of the debts, and he finds out I've racked up $2 million of taxes for the partnership. Trent's now personally liable for that taxes. And he'll probably come after me with a hitman, but that's beside the point. The point is a partnership is even more so risky. And of course, what absolutely blows my mind is how accountants go, oh, we should set you up as a sole trader, or we should set you up as a partnership. And of course, being a lawyer, when I was a lawyer, that's the first thing we're taught, like, you just don't do that. So, of course, how many of you here are listening in horror because you know you're a sole trader in partnership and you know you're basically Albo's duck? Just, if you are, just type a Y if you know right now you're Albo's duck. In other words, you're a sole trader or in a partnership. No one? Yeah, there's a few of you, not many. Okay, so who here does actually have a company in trust structure? Just type out me if you do. You've got something already happening. Okay, a few of you, good. Okay, great. So that's how sole traders work, so to speak. So, and partnerships. So then the next thing, of course, you would want to do is to start going as to how you can deal with the inequality and how to escape the tax trap and really use it correctly, so to speak. So one of the things with companies we've mentioned and trusts is the ability to legally distribute and minimize taxes. That's the key. And most people who've got trusts and companies don't really know how to use them. And you really do want to use these things because they can really save you quite a bit when you're in the middle class level. They're not very helpful once you start hitting this $300,000, $400,000, $500,000 a year income. But once you start getting into that one, you've got to go to the next phase and start looking at various ways of doing it, like debt, living off debt, kind of deductions you do with high net worth accountants. As you hit the million, where do you start setting up foundations? Where do you start moving and becoming an international global citizen and things like that? So the deferral of taxes through retained earnings and things like that. So using structures to avoid the tax trap. Personal name gives a maximum tax, no income splitting. As soon as you're in a structure, you can distribute income. One of the reasons I especially like trusts is because trusts, like you, enable you to give your money where you want it to go to a little bit more. So to give you a very simple example, let's just say you've got Warren and I'm running a church. Let's just make up a scenario, and I'm running my own church. I'm basically set myself up. Let's say I've got my business over here, and let's just say that I've got a trust happening here and a foundation. Let's just say let's just say I've got a trust or whatever else. Let's say I've got a family trust. I can always distribute money into the foundation if I wanted to, as an example. So if I've got discretionary trust, I can just move the money into the foundation and minimize my taxes that way. Or have the foundation owning the company or the trust is another way of doing it. Let's just say that I genuinely did a philanthropic organization. So there's another example over here. Let's say that I'm running a business through here. I end up spending a lot, buying property, paying taxes. But let's say that 1/4 of it I give into my foundation to do charitable work. That's all tax-free and things like that, and have certain other benefits, grants, and all kinds of different things happening. The moment you've got it, what a trust and company does, it sets up your affairs, let you do things that you otherwise wouldn't be able to do. So it's kind of like a skeleton. And this is why I say to people, because a common question is, well, Warren, I'm still pretty new to all this. I'm not really like making money like Kerry Packer or anything. Should I wait? And I'm like, well, the problem when you wait is by that time, let's say that 1 year, you've already made 300 grand and you haven't had time to move your structures around. It's too late to move things around then legally. And then by then, to try and transfer other trusts might have capital gains tax. So you want to be setting your structures up early in your affairs. And if you've already got structures, you want to always look, is there ways you can use your structures better for asset protection and tax minimization? Type of me in the chat if you've got structures, but you have a feeling you could be using them a lot better than you're using them. Just type of me if you have a feeling you could be using them a lot better. Because my experience is you take 10 people in front of Trent and I, and we see what you've got. 9 times out of 10, there will be ways you're not using your structures to full capacity. That's my experience, 9 out of 10 times. Maybe I'm being generous, maybe more, it's like 19 out of 20. More often than not, people aren't using them to their full capacity. I still remember even years ago, I was flown into Adelaide to meet one of the richest 100 people in Australia. And I must admit, I was nervous. I was like, shit, I mean, surely their accountant has got everything covered. I mean, they're paying like, a huge retainer just to get me in based on a recommendation. I mean, how am I going to know more than their accountants? And fortunately, in the first hour sitting with them, I found 3 things that their accountants had missed straight away. And I was like, fuck. And, it saved them a lot of taxes. And keep in mind, because they're on the rich 100, they're on every audit list. So everything had to be by the book, like by the book. And what I found 3 things by the book. So there's a lot you can do. So again, we can't teach you and make you a world-class expert in an hour on this. I just want you to get the idea to show why it's so important you want to get personal advice and guidance and set yourself up properly, because these are the kind of savings you can make. An example I've given down here is you've got 200K. Let's say that you're going to pay up as much as $97,000 or something like that. As a company, you might end up paying, let's say at 48.5% in theory. As a company, you pay $55,000 and there's a $42,000 saving. Now, you get the drift, so to speak. Now, I just realized those calculations are technically wrong, so I'm going to fix that up. I'm just going to fix that up, everyone. I just realized it's actually an error, and I want to make sure it's accurate. For some reason, it got it wrong. So I think I had a brain failure, did that one. So I think we've got, so yeah, so basically, this is not correct. Basically, yeah, so for whatever reason, this is not working, this tax calculator. It's giving me wrong information. Let me try again. How funny that is. Try one more time. How funny is that the ATO calculator is incorrect. Okay, got it right now. So the correct figures that should have done it, that somehow got mucked up, was that. So you're going to save 15K on that. And of course, the more it goes up, and if you can use a trust, it will be even less. So basically, it'll be 15K on that one. Then let's say that you've got a trust, it gets even greater, which I'll show you very shortly. So basically, and as the income goes up, and every dollar that you earn over 200,000, you're paying 48.5% tax. So compared to that and 25%, for every $100,000 extra that you earn, you're saving $23,000 in tax minimum. Who thinks that's pretty cool? Just from basically doing that. Excellent. So these are the things with companies. You've got this inverse tax relationship where it starts to go down bit by bit. The other thing too is applying the Robert Kiyosaki system that I mentioned to you, which is that the rich earn and then they spend and then they pay taxes. In companies, there's a lot of things you can claim, but in a company, but are harder to claim in your own name. So this is the other reason why. So there's a number of different reasons why you would use a company rather than a trust, as an example. So one very common one is when you've got a very large successful business that's going to be over 6 million. And the reason why is that you don't get a lot of the capital gains tax discounts that you would get anymore once you pass the 6 million mark under Australian law. So when you've got a really large business that you plan to sell or float on the stock market or float with small scale capital offerings, then a company's often better because a lot of investors at higher level ones are nervous about trusts. But of course, many of you, that wouldn't be the case. But that's when a company may be better for you to go. So companies can't distribute income to family members as easy with discretionary trusts, for example, as well. If you pay to sell in Australia, it can work out a whole lot better. Buying and holding assets, as I mentioned here, is another one, where if you're going to be holding assets, so to speak, for less than 12 months is another time and things like that. Making personal loans, Division 7A, is another reason as well, where it would not be so good. So they need maximum asset protection for higher level strategies. So basically you need maximum asset protection strategies, particularly offshore planning. Trust provides superior flexibility. So international structures often work better through trust arrangements than corporate for Australian resident, so to speak. Okay, so capital gains tax trap. So here's a couple of problems of companies. If you're going to be buying properties or shares as investment for more than 12 months, and you're not like in that $620 million mark or whatever, they aren't that good to buy and hold properties or shares as investments because you lose the capital gains tax 50% discount. So here's where companies can hurt you. While they're excellent for active business income, they're terrible for passive investments like property and shares. Individuals and trusts get a 50% capital gains tax discount on assets held for more than 12 months. Companies don't. This means if you buy an investment property in a company and sell it for $100,000 gain, you pay it on the full one. Through a trust, you only pay it on $50,000. This can cost you thousands in unnecessary tax. I've had clients literally who I've made the mistake on an account and they've purchased a property in a company, gone to sell it, and they've realized they've been up for double tax. And it's a terrible price to pay by not structuring yourself right from the beginning, so to speak. So the problem is the PSI rules is another example of the company killer, so to speak. Who here has heard of the PSI rules out of interest? No? Okay. How these rules work is that let's say you're becoming a contractor, so to speak. So the personal services income are the ATO's weapon against professional service providers trying to use company for tax. If your company's income is deemed to be PSI, you lose most of the tax benefits. So what this is designed to do, in simple terms, is to stop people from going ahead and setting up companies in or trusts or whatever, when really they're just doing a job and pretending it's not. So I'll give you a simple example. Let's just say that I have a job working for BHP on a rig, okay, and I'm paid, $50 an hour. Let's say that I decide, hey, I want to reduce my tax and get a contracting, but I just do the same thing on an hourly rate. The tax office say that's the PSI rules, and even if you've got a company, we will treat you as if you're an employee slave. We'll treat you that way. The only way you can avoid that is if you meet a couple of exceptions. One being that I'll give you two examples that they say is okay. One is the results test. So what that means is, let's just say that I'm working for $50 an hour for an accounting firm, and I try to become a contractor. But they'll say whatever, you're going to pay full tax as an employee. Let's just say instead I go to the accounting firm and make a deal with them, but I'll get paid 35% of whatever the billings are. So if I bill, say, $10,000 a month, I will get paid $3,500, or $20,000, I'll get $7,000. The ATO said that's fine because you're taking risk now. Now you're like a business owner. Or let's just say that you set up a legitimate business, and let's say that you earn less than 80% of your income from any one client. So let's just say that I'm working for 3 different firms. They'll say, okay, now provided you got your own, like tools and a couple of things in your contract, it's okay. So just make sure if you're going to become a contractor, so to speak, you just got to make sure you're keeping these in mind when you're doing it. Don't have time to go heavily into it. It's just important to understand the PSI rules. Discretionary trusts are very popular, and I'm a big fan of them. And where possible, I prefer to wear trusts, so to speak. Trusts have been so protected in the courts since basically Jesus was a boy. Basically, every major court talk about trusts. And the reason trusts are so powerful is in the Middle Ages, they came into being heavily when the knights would go to the Crusades, and they wanted to make sure that governments wouldn't seize their money when they were away. So what they would do is they'd set these things up called trusts. They'd put them in the hand of trustees, like trusted friends, like me going off to war and saying to Trent, hey, Trent, I'm putting all my assets in your hand under a trust where we agree it belongs to me. And then I go to war. They can't take my assets off me so easy because Trent owns them in a trust. That was actually one of the major times when trusts became used for asset protection, so to speak. So trusts are fantastic for asset protection. There's a very good reason why pollies and farmers all have them, literally. There's some pretty funny stories when it came to that. In 1999, the government announced a new commission called the Ralph Report, and that was going to tax trusts as companies and a few other things. They spent millions on getting it ready, and it was rejected in Parliament. Can anyone guess why? Doesn't take any brownie points to realise, because just about all the politicians have trusts, and the National Party, all the farmers have trusts. The trust has always been a hard one for government to do a lot about. I'm not saying they won't, but it's a hard one for them to do much about without pissing off a lot of people. So that's kind of how it's worked. My guess is if they ever target trusts, what they will do is they will set it up so they target a little person, and they'll make special exemptions to people at a high level. Otherwise, by and large, trust is one of the most well-used things. I mean, it enables you to split income. It enables you to cut your taxes down quite considerably by distributing it among your spouses, your adult children, your parents, your grandchildren, each using their tax-free threshold, so to speak. So A big benefit too from trust is the old ancient principle, which I shared last week, of you can control the assets, but you don't own them. The beauty of a discretionary trust is you really genuinely don't own what's in there. You actually don't own it. It's owned by the trust on behalf of various beneficiaries, so to speak. So it's the ultimate asset protection strategies. When assets are held in trust, you don't own them, the trust does, you control them as trustee, but legally you don't have ownership, the creditors can attack. So the separation between control and ownerships is what protects wealthy families from lawsuits, business failures, and creditor claims. And it's why every wealthy family uses them as the foundations of wealth asset protection planning, and especially in a litigious society, and especially in a world where governments have lost their absolute friggin' marbles, and they're already talking about wealth attacks like never before, as we shared about last week, where they're talking about taxes on realised gains, about death duties, about looking more at trusts and everything. You really want to make sure you're very well structured so you're not sitting duck for any creditor. So the ATO has woken up to this, and so there are some rulings you've got to be mindful of, and that's why you want to work with very good advisors. Keep in mind that as we currently speak, the ATO had their butt kicked in the full federal court in the Bendel decision. The Bendel pretty much held that a lot of what the ATO were trying to do couldn't be done, and that trusts can distribute to different groups, and even if they don't pay, it's not a big issue. The ATO are appealing that to the High Court. I've always said to people that I do think that if you distribute from a trust to anyone, you should pay it across. So that's beside the point. It doesn't change the fact that it makes it a really good asset protection strategy, so to speak. So there's the ATO have been clamping down, but like I said, they're losing in court. And a lot of their stuff they claim is problematic. I just say to people, just use common sense. Like if you go ahead and make up a whole lot of strange deductions, which you then transfer across, which don't have any real substance, you're going to get looked at, you'll get in trouble. If you use your trust to distribute legally between your different beneficiaries, your corporation, your foundation, your various trusts, and then you make sure you pay the money across, it's really difficult for the ATO to have a lot of trouble unless you're doing something pretty strange or shady, so to speak. And look, at the end of the day, the wealthier you get, the easier it becomes because the more you can engage lawyers and experts to help you with your structuring. Who prefers the idea of structuring correctly, just getting wealthy and doing it right from the start? Just raise your hand. Excellent. Because that's you, then you're in the right place, and you're definitely who we're mainly speaking to. Often you'll hear, has anyone heard their accountant say that trusts are dead now? Just write the word dead in the chat if you've heard that statement. Because every now and again I hear this, like, yeah, I mean, I can assure you they're not dead. And they're well and truly being used. Again, we can't promise. I mean, who knows what the Labor government can do, but just keep in mind, if the Labor government change all this, all the politicians and farmers and major people are going to be affected. So I think any changes to trusts are going to be done very carefully because the last thing they want to do is jeopardise their own little affairs. It's one of the reasons why under a Labor government, ironically, offshore structurings is more in vogue again, because the Labor government are more kind of want to do that kind of stuff themselves from what we understand, whereas the Liberal government don't. So the crackdown has eliminated the lazy cookie cutter strategies, and that's what I always say. It's always good to structure properly, and yeah, being told trusts are being dismantled in family court, yeah, look, okay, the one-time trusts don't work, good point, Graham, is family court. Family court, absolutely, I mean, since 2004, I'm pretty sure trusts can be looked through by the family court. Family court, ignore them. You've got to be a lot more wise if you're ever going to deal with that. So this is not for family court purposes, but good that you let me know that, or reminded me to say that. So I actually spoke on this issue when I used to be a lawyer. I did a massive presentation to the Law Society on this exact issue of trust in the family court. So I do know a bit about it. So as I mentioned here, they do use these structures and therefore they're going to be loath to get rid of them too quickly. So I've just got a nice little bit of an example for you here. So you've got Donald and Daisy with 3 kids, Huey, Dewey and Louie. Daisy runs a finance broking company. She makes money. Donald decides to trade profit, options to make some profit. They want to give some money to their church. So what's the optimal tax structure, so to speak? So Here's some numbers for you depending on what's actually used. Pretty amazing, really. So if it all went to Daisy, that's what she would pay. If it went to Donald, that's what you'd pay as a lower income. If you split the income, you'd pay that. If you paid straight to the church and the trust rather than a normal tithe, you pay that. A very simple example how using a trust can save you taxes. Like half your tax just by having the structure to have available. Who thinks this is fantastic? Who thinks it's definitely worth doing that? Like, why would you not set up a trust when you can do this as you make money? Why would you not? That's what I tell people. Why would you not do it? You're crazy not to. So many good things about trusts, so to speak. So another one I promised to cover on quickly was super. Now, I'm always a bit cautious because this is so regulated that I've got to be mindful what I say on this one, because you've got, like, since 2017, anyone that's not a licensed super advisor is limited. The main thing I'll say to you is I'll take you back to when you should set up a self-managed fund, and we'll actually look at ASIC side itself. So when should you, or just straight from the horse's mouth, so to speak. So yeah, so basically this is what comes directly. ASIC, I've always set around $200,000. So generally the idea is that if you make $200,000 you got sitting in super, you may argue that it's okay to do it. Keep in mind they're very conservative at ASIC. So what they're saying is that as soon as your super passes the $200,000 mark, provided you're willing to self-manage, and that is the key, because self-managed means you manage it, not someone else. So you definitely don't want to set up a self-managed fund and then not manage it, because you will pay a few grand a year in accounting and auditing fees to run one of these things. So if you're going to purchase cryptos, shares, property, investments and that, you can do a self-managed fund, and I mean, and basically just, and you can get some concessional rates and things like that, and you can control your wealth in that rather than have it sitting passively in a managed fund, or so to speak. So generally $200,000 is what ASIC say. And of course, keep in mind they're being conservative. So many people might start with 100, 150, but officially even ASIC and planners are telling you around 200, 250, you should be okay to do it. So there's various things that are really good. Now, keep in mind that Albo was said, but 3 million or over now, they're going to be mean to you and hit you with extra taxes. So provided you're less than that, it's still relatively tax effective. Just keep in mind that once you hit the 3 million, you fall into Albo's socialist clauses and they start taking some of your money. So you take one for the team and basically help out your fellow Australians, whether you like it or not. So that's basically just to keep that in mind. So superannuation for tax after 60 is at the present 0% when you're in pension age, and you enjoy 0% tax. So keep in mind with super, I can assure you I'm not an expert in this area. I've stayed deliberately dominant since 2017, so I won't get myself into any unnecessary trouble when I really don't need to. I'm not the biggest fan of super myself because I see it's a beautiful thing for governments to, it's a very attractive nest egg to fund Albo and his merry men. But in saying that, there still is a lot of benefits to super, and if you've got a reasonable amount in it anyway, it's worth seeing a financial advisor and getting one set up. And I actually do say it's a good idea to see an accountant or advisor or things like that to get it set up. So super can be a good way as well to minimize taxes within the system and build up some retirement wealth, so to speak, assuming that you have some trust in the government. I mean, you can do everything in trading in super now, but you can just about do anywhere else. You can buy property. You can lend within strict rules even. You can trade markets. You can do CFDs. You can purchase cryptocurrencies in it. There are some strict rules. You've got to make sure that you meet certain requirements to prove chain of custody of the cryptos and make sure you've got an accountant who knows. But super is another way you can go to set up. So there's different ways that super works. You've got your accumulation phase where you actually grow your wealth. You hit your age 60 and then you move into your pension phase is what they call it. So that's the dummy's guide to super. Up until age 60, by and large, you're in accumulation phase. After 60, you hit what's called pension phase, which means when you hit that 0% taxes and things like that. And then they got all kinds of deductions and special rules around things that you contribute to the foundation. So now you've been given a bit of an overview. So I'm going to take some questions in a minute, so you can feel free to start throwing them in there. And then after questions, we're going to introduce Trent to come back on just to share how you can take some further action. Before we ask the questions, just raise your hand or type a Y if you're really interested to talk to someone, to at least inquire to take further action. Just type a Y or whatever else, raise your hand. Tell me that you love me, whatever helps you communicate the message. So basically, you now possess the knowledge. So you've now got a really good start to move yourself forward. So, and that's a bit of a summary. So any questions that you've got before we get Trent on? This is really cool. I'm actually really going to time again. So I'm sure Trent's impressed. I've been right on time with that webinar. So let's have a look at what questions we've got so far. Some of them I could see, but there's lots of that. So what's the minimum super you recommend to change to an SMSF? Yeah, I've mentioned that once. That's been answered. I've quoted ASIC. Yeah, so the best thing to do is send your questions through. Rebecca, my husband is definitely falling for you the more time we see you. It's great. Tell him I'm falling from too, even though I can't see him, Rebecca. So I like that. So Pat, have a family trust, but no company. Yeah. Mel, interested foundations. Yeah, that's a separate thing. We're probably going to cover that at some stage, but not at the moment. What's the difference, Angelique asked, between a discretionary and testamentary? Good question. It's simple. One, you're alive, one, you're dead. So a discretionary trust is for when you're alive. A testamentary trust is for when you're dead. It's a will. So they're two completely different things. In fact, a discretionary trust is what's called an inter vivos trust. If you really want to get technical, and I want to, show off and be egotistical and show my lawyer kind of jargon, you've got an inter vivos versus testamentary. Inter vivos means a living trust, and like discretionary trust, unit trusts are inter vivos. Testamentary means you're dead. So there you go. You've all learnt some legalese now. Inter vivos. Susanna's interested to know if I should be buying a home in my own name or not. Well, I can't give personal advice on stuff like that. General rule, I say as a general comment with buying a home in your own name, it's usually you've got to be very mindful about doing anything other than that, because as soon as you put it into a trust, you automatically lose your capital gains tax exemption for a family home, number one, unless you do really cute planning. Number two, if you're in New South Wales, Victoria, you could end up paying an absolute wallop of land taxes, extra land tax, you've got surcharges. And yeah, so you might end up paying more land tax, you might end up paying capital gains. So it's possible, and sometimes it's good doing it, but you've really got to get some advice before that. So really good advice. So what your accountant's saying is very complicated, Suzanne. So it's possible to do that, but you better make sure it's doing it properly, because the ATO will look at that if it's done incorrectly. Is it worthwhile putting these structures in place if the household is earning under 150? It depends on what you're doing. If you just got a job, you won't need it. But if you kind of got a contracting or business, then definitely for asset protection, if nothing else. So if you're running a business, then definitely. Are you running a business or contracting? Then definitely. Janine, when would you use a unit trust over discretionary trust? A good example of that is that let's just say that I'm just doing a business on my own or with my son, James, then he and I, and we do that. We've got a discretionary trust that we use for our stuff. But let's just say that Trent and I decide to do a business together. Trent's not my brother, my sister, my boyfriend. So I'm going to basically have a unit trust of him, not share a discretionary trust of him. So Deb, I know you quoted ASIC's min for super fund. No, I will not make any personal recommendation on a minimum for super fund because that's not legal. So the answer to that question is I will not answer that question. What I will say is that ASIC says 200,000 and they're conservative. If you've got anything more than 100 to 150, by all means, go and have a chat to an accountant or someone and ask them if they think it's worthwhile. And when you sign up for, if you sign up for one of the free consults with us, then by all means, I know Trent's very connected in that area, knows good accountants and things like that. Will the trust protect our real estate once real estate is tokenized? Yeah, that's kind of like asking if a car drives a certain speed. The point I'm making is that it depends on how you structured it and what you're doing it and in what form. We have got things like second mortgage structures and things like that to make it like that. But yeah, that's the short answer is it depends on what you're doing, and we're not even tokenized yet, so I haven't looked into that much anyway. Suzanne, mortgage trust over the home. Again, that's kind of that's what you're probably thinking of there, and I'll point this out for you, which you can look at in your own time rather than get people off track here. If you go to Global Wealth Club site and have a bit of a look, I'll just open the members area. So if you go into the members area for the Global Wealth Club, assuming you're a free member, you will find there's some really cool stuff in asset protection in here, and there's some really good stuff here, Suzanne, on mortgage trust that you can watch and ways you can protect your home using mortgage trust. So anyone who wants to know that, there's good 7-minute simple videos, all free, won't cost you a cent, better than anyone else's out there. So hopefully that answers your question, or better than anyone I know so far. So I'm the sole executor of my mother's real estate in Brisbane. Would it be better for me to do a testamentary trust? Well, you've already got one, but you probably should go see an estate planning lawyer who specialises in that and see if there's anything else you can do. That's my simple answer to that. Natalie, one of us is a sole trader, the other earns a wage. That's a great question, Natalie. Okay, so that's good. That's exactly a classic of what I mentioned. So a sole trader, remember what I said to you, if you came to Trent and I and said, hey, you know, me and my husband want to make absolute sure we are at most risk of being sued and pay the maximum tax that we go up. So even though you might not pay a lot more tax, if you get yourself sued in the business or something goes wrong with the ATO, you will be personally liable for everything. And you will have your credit rating ruined and everything. I never recommend a sole trader for people unless there's a very good reason. You could, even if you just do a cheap structure of some kind, you never, ever want to have that. So short answer is I cannot say strongly enough you want to have a structure for your business. That's just my feedback on that. Barbara, what is the purpose of an individual trust compared to leaving in your personal name? Well, again, asset protection is a big one. By having it in a trust, not having it in your own name, you give better protection. And again, you can distribute money to various beneficiaries. So individual trust does not require director's ID. Only the corporate trustee requires director's ID. So on that one there. Pat, what is best structure set up for Pat? I have no idea, Pat. I don't know your situation. So my mind reading skills are still being developed as we speak. Okay. Any other question? Aidan, will unrealised capital gains apply to wealth above 3 million, but outside of superannuation or SMSFs? Well, not to my knowledge at the moment, but I can't answer on what they prepare for the future. How much additional effort and cost are needed for each of the different structures? Well, the biggest thing is the amount of effort that you will need if you end up getting sued or having a problem with the government and you're not protected. Then you'll have plenty of effort to be doing. So I always say a bit of small stuff now. The main thing is once you got it set up, it doesn't change a lot. You just got to do a tax return every year like you would do normally. And depending on whether you got a business or which you got to do books anyway, you just got to do your books in a trust and get your accountant to help you. So really, it just means you got to pay a little bit more. You've got to have an accountant on board to help you, but it doesn't. But the amount of effort especially if it's just an investment trust. There's not really a lot of difference other than each year to get your accountant to look after it and things like that. Pat, what is the best structure set up for me and my daughter doing a Forex? Well, again, I specifically said in my first, in the beginning, I do not give personal advice. This is general education. So my answer to that is that generally unit trusts work better for people who want to be independent. Discretionary trust is for a family when you do things together. Best thing to do is have a chat to someone, whether it's your accountant or Trent's going to be making an offer with his free consults. Now, I'm going to mention Trent's free consults are booked out so fast, we're all in shock. So he doesn't have a lot left, but he's going to go through and explain. So maybe, yeah, probably the best thing to do is have a chat with him, and then he can have a look and see what's the best with you and guide you and your accountant in doing that. But generally, yeah, a unit trust or discretionary trust, depending on the pros and cons for each for you. Okay, so who's got some value out of today? Just type a Y. Who's enjoyed it? Who's learned one or two things? Maybe, hopefully, three. Wonderful. It's great. You guys have been great. You're a great audience, and I'm glad you put up with my rather dark humour. It's how I keep myself amused. Okay, so what are your next action steps? So this is where we get a very you schedule a consult, assess your situation, and take decisive action. On that note, I'm going to invite Mr. Trent Chapman to jump on and share about how you can work more with the Global Wealth Club and Trent to restructure your affairs. So as you can see, Trent's the friendlier, nicer version of me, my doppelganger. So Trent, over to you.
Thanks, mate. Good presentation it was, and thanks to everybody for watching. There's quite a lot of people on the call, and I've only got about 5 minutes up my sleeve to be on another webinar. So I'll just do a quick bit of a recap on a couple of things that may help people, and probably more so people that are new to this space. Is everything that sort of Warren has spoken about. The key thing is just to know that they're all different entities is a really key thing to take away. And one of those entities as well too is when you operate in your own personal name. Now, some people may be familiar with the term strawman, and it's what I utilize, that term strawman. So really the key to everything to know, guys, is that your strawman's a type of entity, a company's a different entity, a trust is a different entity, an offshore or a foundation, they're all different entities. And each different entity has a different set of rules to it. And there's different things that you can do with those entities. So what Warren's really describing tonight is around about how to create your web so you utilize all the entities that are appropriate for you, depending what your journey is, where you currently are in your life, what age you are, maybe where you make your income, what you might invest in. But I've always stood very solid around about companies and trusts, like very solid. I call that a level 1 to sovereignty, to really being empowered and control of your own finances. So a level 1 for me is very much around about a stream where you make your income through one trust with a company over the top. And then you also have one where you make your investment, just like Warren showed earlier. I truly believe that that is the best place, and we all should have that, because what it does is it minimizes how much that you use your strawman, or how much Mr. Trent Chapman uses. Because it's important to remember, again, what we call to sort of call those taxes that we pay. Those taxes come back to your strawman. So the key is, as Warren's really alluded to tonight, is that you don't really want to own anything, but you want to control everything. Now, that can be hard for some people because you've got to get out of your own way a little bit, especially for people that might be in a bit of a survival mindset. They think, well, it's not in my name. How do I have it? How do I have it? Understand that you are in full control of your trust, your foundations, your offshore, and all the rest of it. So it's around about creating that web. Now, I would believe, I think there's a good 100 or nearly a couple of 100 people on here tonight. So the one thing that I will say is that all those people that are on here tonight have obviously woke up that there's better ways to do things. Whether that was a bit of a spiritual growth that you've had, where you've had a bit of an own awakening at some stage, or whether you just kind of peeved off and sort of feel that you've been treated like a slave for way too long. Well, you're on here now, so you woke up. And what Warren really alludes to in tonight's presentation is that you've got to clean up, right? Like you have to clean up. Now, you've got to take action. And that's one thing that it's all about, is that things do change, as Warren has said a lot tonight. There's opportunities, and when there's opportunities, you've got to take opportunities. And that's really what the wealthy do. And, everybody knows that I would rather refer to the wealthy as the wise, because the wise become wealthy. You've got to be wise. So hats off to Warren again for another fantastic presentation. It's really thorough and in-depth. I like what Warren does at GWC, but more so I'm really around about empowering Australians, and I'm well aware of what's going on, and I'm well aware of what 2026 looks like. So as Warren did say, I jumped on last week just for a couple of minutes. I did open up some appointments, and I think they're all gone in 10 or 15 minutes. So I did open up a few more, but I'm a man that doesn't have much time, but I have made available what I can make available. But what I will say to you guys, as Warren just shares how to book this, is be prepared for these consults, because 45 minutes isn't really that long. Ideally, I'd like to have 90 minutes, but there's a lot of people, so I want to try and cover everyone the best that I can. So some things to be mindful of is that you'll have a questionnaire. So fill out your questionnaire. I spend about 20, 30 minutes beforehand or early in the day on those consults, and I'll review everything where you are, so I can come into that consultation ready and understand where you're at, so we can kind of skip the small chat. Another thing would be is that if there is more than one decision maker in your family or in your little network, please have that person on as well too. There's nothing worse than having to try and relay some information that you might not be 100% clear on. So please have those people on there. And I would also say as well, just with the demand that there is, and I don't mean to be rude when I say this, but I really just want to be around people that want to take action. So if you're ready to take action, then please book that. Please make that consult. I speak a little bit more freely than what Warren does. Again, I'm not an accountant, I'm not a lawyer, I'm not a financial planner, but I'll just tell you exactly what I would do and exactly how I would structure it. Some things for some people as well too that may just be in positions where there might be PAYG employees. I know a couple of chats I had with people last week. I just sort of sparked the idea of, well, why not have a chat to that employer and maybe look at being a contractor and sort of changing your affairs and what that can look like. I believe that two of those people had great responses, and straight away that's going to change their dynamic. And I can cover all those things with you individually. So in a nutshell, guys, you woke up, time to clean up. I'll stick around until the end of the year, and I've made some things available. So please book in, please be prepared, please do your questionnaire, and make sure that your decision makers are there. I'll just leave you with one last little thing, because I've got to jump off in a minute here, but I will leave you with one last little thing that was kind of alluded to Charlie Kirk at the start. And we definitely know that when religious views start to get attacked, that we are in a society that is in a lot of trouble, like a lot of trouble. I think that 2026 is going to be absolutely mind-bending for a lot of people. And it's what I call, you're either going to fall to the Great Reset or you're going to move with the Great Awakening. Now, similar to how Warren showed that tax farm with that wealthy at the top, and then you've got the welfare down the bottom. Well, that welfare down the bottom will be the Great Reset, and that number of 15% will be a lot larger. The wealthy at the top as well too will be a lot larger. Again, the wealthy and the wise. But that tax market number two, that whole slave system, well, that's the middle class, and that's what's been attacked the last 5 years, and that's what will collapse. I think, in my personal view, I think next year we're going to see a lot of this happen. So please take action. If I can help, I would love to help you. And if not, then I wish you all the best on your journey. And for me, I think you've got everything in there, mate. I'm just going to have to jump off now because I've got another webinar to get to. But
I
thanks.
know.
Appreciate being a part of GWC, and I look forward to chatting with those that would like some assistance on their journey of life at the end of the day.
Excellent. Thank you. And Trent, don't forget to send me a link to our other webinar as well.
Yeah, fantastic, mate. Thanks very much, guys. I'll leave you now, guys, but thank you.
Okay, thank you, Trent. Well, we've given the booking link there. Just type a Y if you actually are planning to book in with him. Like literally, we opened it up thinking we would get about 15, 20 slots, and they were all gone. So we've had to open up new ones. So just keep in mind that once the free ones have gone, which will be ending by 31st of October, we'll be having to do paid ones just to handle the demand within. So if you do want a free one and you plan to take action, I suggest you probably book tonight. And it's not a scarcity thing. I know it sounds like it, but literally that's what happened last week. We had 33 people last week and 18 people booked in for a consult, which I certainly didn't see coming. And then since we had another 5. So for whatever reason, it either Trent's good looks or it's his knowledge or both. So thank you, everyone. You've been a great group. I look forward to seeing you next week at the Crypto Masterclass that will be happening same time, same place. Bye for now.